Welcome back, legends. It's your main man, Mac Hoddle, here from the team at Crypto Tax Audit. Popping bottles because Bitcoin has hit that epic 100,000. It's not just Santa bringing gifts this year. Looks like Satoshi did too, huh? Bitcoin has not only knocked on the $100,000 door, but has smashed it down, celebrating a grand entry into six-figure territory. This monumental milestone, long viewed as the Mount Everest of market caps, has finally been summited, thanks to a potent mix of bullish cheerleaders, strategic halving events, and heavyweight institutional backers. As we approach the holiday season, a time for exchanging gifts, traveling, and reconnecting with loved ones, it's also a prime opportunity to make some smart money moves. This includes taking a closer look at your crypto taxes, ensuring everything is in order, and exploring ways to potentially save some money before the year ends. Ever heard of tax loss harvesting? It's a term tossed around a lot among crypto folks, but what is it really? And how can you use it to cut down on what you owe in taxes? Let's break down tax loss harvesting and show you how to make it work for you as the year comes to an end. Just a heads up before we jump in. What we're talking about today is all about learning, not official tax advice. As always, make sure you have your notebooks and pens handy. This is info you'll want to write down. Hit that like button and don't forget to subscribe for more epic crypto content. Let's get started. Think of tax loss harvesting as the financial equivalent of making lemonade out of lemons. Here's how it works. If you've bought an asset and its value has dropped below what you paid for it, you're sitting on what's called an unrealized loss. It's unrealized because you haven't actually locked in that loss yet. It's just on paper. Now, you can't just deduct these paper losses from your taxes. You need to make them real. How? By selling or getting rid of the asset. This locks in your loss and turns it from a theoretical one into a real one that you can report on your taxes. Why would you want to do this? Because it can save you money at tax time. The U.S. tax system allows realized capital losses to offset capital gains first, and then up to $3,000 of other income if losses exceed gains. If your losses outweigh your gains, they can even reduce other types of income, lowering your overall tax bill. It's a legit strategy that's often overlooked, but can be a real game changer in managing your investment taxes smartly. Got questions about tax loss harvesting? Ask away in the comments. If you're finding this guide helpful, drop a like. Let's simplify this with an example to see how tax loss harvesting works in action. Imagine Ivan, who's into cryptocurrencies. In 2021, he bought 4 Ether coins at $4,000 each, which totaled $16,000. Fast forward to 2023, he buys 100 Solana coins at $200 each, which totaled $20,000 each, spending $2,000. When Solana's price triples to $60, Ivan sells all his Solana coins and rakes in $6,000. From this sale, Ivan has made a $4,000 capital gain, since he spent $2,000 and sold them for $6,000. Now, here's where it gets interesting. By December 2023, Ether's value has dropped, and Ivan's 4 Ether coins are now worth $8,800, down from his original purchase price of $16,000. This leaves him with an unrealized loss of $7,200. If Ivan does nothing, he would report a taxable gain of $4,000 for the year, provided he hasn't sold anything else. But if Ivan decides to sell his Ether coins, he can turn that $7,200 unrealized loss into a real one. By doing this, Ivan not only erases his $4,000 capital gain, but also ends up with a net loss of $3,200. Here's the kicker. Ivan won't owe any taxes on his capital gains because of this move. Plus, he can use $3,000 of this loss to reduce other types of income, like wages, and carry over $200 to the next tax year. This strategy smartly turns what seemed like a bad investment year into a savvy tax-saving move. Ready to optimize your crypto taxes like Ivan? Head over to cryptotaxaudit.com to start your tax strategy session today. Let's look at when tax loss harvesting really comes in handy. Just like in the example we discussed before, it's especially useful in years when you have taxable gains, because U.S. taxpayers pay taxes on their net capital gains. That's after subtracting any losses from your gains. But what if the markets are down, like they were in 2022? Tax loss harvesting is still a valuable tool. Even if you don't have any realized gains that year, any losses you do realize can still give you a tax break. In the US, you can deduct up to $3,000 of net capital losses against your regular income, like your salary, business income, or dividends, each year. If your losses exceed $3,000, you can carry over the remaining amount to future tax years. For example, suppose Alex lost $100,000 in the market in 2022 and had no other capital gains that year. Alex can take a $3,000 deduction against his other income for 2022 and then carry over the remaining $97,000 in losses to future years. If in 2023, Alex makes $105,000 in capital gains, he can use his carried over $97,000 in losses to reduce his taxable gains to just $8,000. Nobody likes losing money in investments, but the silver lining with tax loss harvesting is that every dollar lost can potentially reduce what you owe in taxes on other gains. In Alex's scenario, he's only taxed on $8,000 in gains for 2023, even though his actual gains were $105,000. This strategy turns potential financial setbacks into opportunities for future tax savings. Before we tackle the wash sale rule, make sure you're subscribed so you don't miss out on crucial updates that could impact your crypto investments. The Internal Revenue Code section 1091 states that in the case of any loss claimed to have been sustained from any sale or other disposition of shares of stock or securities, where it appears that within a period beginning 30 days before the date of such sale or disposition and ending 30 days after such date, the taxpayer has acquired, by purchase or by an exchange on which the entire amount of gain or loss was recognized by law, or has entered into a contract or option so to acquire substantially identical stock or securities, then no deduction shall be allowed under Section 165 unless the taxpayer is a dealer in stock or securities, and the loss is sustained in a transaction made in the ordinary course of such business. For purposes of this section, the term stock or securities shall, except as provided in regulations, include contracts or options to acquire or sell stock or securities. Here's something important for investors to know: the wash sale rule. This rule says that if you sell an asset at a loss and then buy the same or substantially identical asset within 30 days before or after the sale, you can't claim that loss on your taxes right away. Instead, the loss is deferred until you sell the replacement asset. This rule is there to stop folks from claiming tax losses while keeping their investment position essentially the same, which could just be seen as a tax trick. And it's not just a US thing. Countries like Canada, the UK, and Australia have similar laws. Concerned about how new tax laws might affect your crypto investments? Visit cryptotaxaudit.com today and schedule a call with our experts for personalized advice and strategies. Does the wash sale rule apply to crypto assets? For a while, crypto investors in the US found a loophole. Since the tax code refers to stocks or securities and treats crypto as property, not securities, crypto investors could sell their losing crypto investments, claim the tax loss, and buy the same crypto right back, maintaining their position in the market. However, this strategy is pretty aggressive, and both the IRS and Congress are onto it. There's been talk, especially with the Build Back Better Act, about closing this loophole by extending the wash sale rule to digital assets, although it hasn't been passed into law yet. But with every discussion about digital asset tax reform in Congress, they keep bringing up adding digital assets to the wash sale rule. Considering it could bring in more tax dollars, there's a good chance it might get passed soon. Now, no matter if you're ending the year with gains or not, it's always wise to give your investment portfolio a thorough checkup. This holds true whether you're invested in cryptocurrencies or traditional stocks. Investment can shift dramatically over time. A project or company that looked promising when you first invested might not hold the same value today. The savviest investors continuously absorb new information and reassess their investment choices to stay ahead. Many investors set aside time in December for this task. Why December? Because it's the last chance to sell off any underperforming investments and claim those losses on your taxes for the current year. Doing this not only helps in managing your tax liabilities, but also strengthens your overall investment strategy. Remember, History is littered with assets which once soared but never returned to their peak glory. What if you want to maintain exposure to the same asset? Let's say you bought Bitcoin at $65,000 and now it's down, but you still believe in Bitcoin's future growth. You need to realize the tax loss, but you don't want to completely part with your exposure to Bitcoin. One approach could be to sell your Bitcoin and then buy wrapped Bitcoin, which essentially represents Bitcoin on the Ethereum blockchain. However, it's important to note that regulatory bodies have not clearly defined if buying a wrapped version of the same asset skirts the wash sale rule, so there's a risk there. If you prefer a safer route, you might consider selling your Bitcoin and investing in a related asset that tends to move in sync with Bitcoin, such as another cryptocurrency with similar market dynamics, or even shares in a Bitcoin mining company. This way, you can claim your tax loss while potentially maintaining exposure to similar market movements. Tax loss harvesting is a powerful tool for crypto investors aiming to reduce their tax bill. However, it's not without its pitfalls. It's vital to stay updated with the constantly changing tax regulations and understand the associated risks. Equally important is maintaining accurate records of your investment's historical cost or tax basis. This can mean leveraging reliable tracking tools. Are you struggling with tax calculations or wrestling with losses? Visit cryptotaxaudit.com for professional advice and personalized consultations designed to take the stress out of tax season. And for all of you out there looking to explore this topic in greater depth, don't miss the Clinton Donnelly Show for expert insights and actionable advice. Smash that subscribe button to keep getting these crypto tax tips. No fluff, just the basics you need to keep your gains in your wallet and your taxes in check. So until next time, keep hodling and keep stacking those tokens. See you next week.